biggest macroeconomic story of the coming week is likely to be the first Federal Open Markets Committee meeting of the year. It will take place on the 26th and 27th of January, although it has to be said that Federal Reserve Chair Jay Powell is not expected to announce any change to interest rates or quantitative easing, QE. The headline Fed funds rate stands at 0.25%, and the US central bank's committed to $120 billion a month of quantitative easing. Moreover, Fed officials, including Mr. Powell, are saying there'll be no taper of QE or raising of rates or tightening of policy until inflation is running at or above the 2% target and America's reaching full employment again. Economists interpret that to mean there could be no tightening of policy till 2023 or even 2024. The biggest company news of the week may also come stateside, because Apple reports its first quarter results on the evening of Wednesday the 27th of January. This might grab a few headlines, because analysts think Apple will generate sales of more than $100 billion in a single quarter for the first time in its history. Analysts also believe Apple will be therefore starting to shrug off the earnings slowdown seen in fiscal 2020, as the pandemic and global recession even had an impact at the Cupertino, California-based giant. The consensus estimate for Q1 is for earnings per share, or EPS, of $1.39, compared to $1.25 a year ago. Just as important will be any guidance from boss Tim Cook for the second quarter, where EPS is currently seen reaching 92 US cents a share in the traditional post-Christmas seasonal dip. Now, that would still equate to a big year-on-year increase, although some investors might argue that a company whose shares that trade at over 30 times forward earnings needs to generate some rapid growth to justify such a multiple. Now, that is something that you can only decide for yourself. Although do bear in mind that over the past 12 months, Apple's market cap has increased by over $800 billion US, and it did so when its four-quarter rolling net profit is expected to come in unchanged at $59 billion, no higher than it was 9 quarters ago, although share buybacks have been helping to pad out EPS. Now, make of that what you will, but buyers of the stock here are clearly factoring in plenty of future post-pandemic growth. Back on the home front, around half a dozen FTSE 100 firms are due to release results, a trading update or host an analysts meeting, with a good selection of mid and small caps scheduled to do the same. Names which may be worthy of further note include the following, although please do bear in mind that these dates can be subject to change. TI Fluid Systems on Monday the 25th of January, PZ Cussons and Saga on the 26th, Fresnillo and Imperial Brands on the 27th, Anglo-American 3i and Wizz Air on the 28th, and then we'll have two Russia-based FTSE 100 members, Evraz and Polymetal, closing out the week on Friday the 29th of January. But the stock which could cause the biggest fuss in the week ahead might just be alcoholic drinks giant Diageo. The company, best known for its Johnnie Walker and Talisker Scotch whiskies, Captain Morgan Rum, Smirnoff Vodka and Guinness, is scheduled to release its first half results on Thursday the 28th of January. Now, for all of the power of its brands and the solidity of its business model, Diageo shares are actually down by around 5% over the past 12 months. This may be due to the hit to the business suffered by pubs, clubs, restaurants and hotels who would have otherwise been selling its drinks. Some investors may also be looking at the balance sheet, where net debt at around £13 billion came in above the company's preferred range last year relative to earnings. And others may have been fretting about Brexit, given the risk of tariffs between the UK and the EU, at a time when America had already slapped import duties of 25% on Scotch whisky, for example. So, when analysts look at these interim results, they'll home in on 3 headline figures. The first is organic growth, so they can check out underlying progress, excluding currency movements and acquisitions, such as last year's $610 million swoop for actor Ryan Reynolds' Aviation American Gin. In the fiscal year that ended in June 2020, organic sales were down 8.4% and volumes were down 11.2%, thanks largely to the pandemic. The second figure is headline pre-tax profit. Analysts are expecting a big bounce in the full year figure to June 2021 from £2 to £3.4 billion. The second half will provide a softer base for comparison, and note that last year's number was burdened by $1.4 billion of one-off charges, which related to brands and businesses in India, Korea and Nigeria in particular. For the record, Diageo's first half pre-tax profit last year was £2.5 billion after just $59 million of exceptional costs. Finally, attention will switch to the dividend. Diageo scrapped its share buyback programme last year as the pandemic hit home and profits came under pressure. The company did, however, squeeze out a 2% increase in its dividend for the last fiscal year to 69.88 pence a share. Now, your benchmark at the first half stage is last year's interim payment of 27.41 pence. Analysts will check out net debt too, which did exceed management's target of 2.5 to 3.0 times EBITDA, or earnings before interest, taxes, depreciation and amortisation, although interest cover was still good at more than 3 times, so there's no need to go thinking that Diageo is in financial trouble. It's more just a matter of how much financial flexibility it has for dividends, buybacks, acquisitions, once it's invested in its core brands and businesses. Note, by the way, that Diageo's streak of increases in its annual dividend stretches all the way back to 1999. Watch out also for any comments on Brexit. No doubt Diageo is looking forward to the return of duty-free shopping once international travel recovers, and trade deals with other key markets like India and the US that could reduce tariffs there, while its supply chain should be really unaffected by Brexit, as most of its raw materials come from domestic sources. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.